boys all grown up. All right, everyone. So welcome to another episode of Personal Finance Boss. I know it's been a while.
Yeah, look who's back on the show.
We are back. We have a great topic. We're going to be talking about how to sift through analyst reports, all of those overweight, oversold, price target, neutral weight, all those different kind of variables. We're going to go through them. Julian's going to give his personal take on them. Which
I'm such a Debbie Downer when it comes to stuff like this.
But first, we're actually going to start off with a little interesting topic. Right now, market has been a little bit stagnant for the past few weeks. But on Friday, Amazon struck with a huge acquisition.
You should probably say what date Friday.
On Friday,
because...
June, what? Yeah.
Let's check.
Monday was the 9th, 18th, 16th, I think?
Yeah, wow, okay.
I know, right? So, on June 16th, so last Friday, Amazon bought Whole Foods grocery stores for $13.7 billion. If you're in Canada, there's only 13 stores, but they are a huge grocery chain in the States. I can't say that I was shocked, though.
Why not?
Because Amazon was planning a move into grocery. They were mulling that futuristic store that had no checkout lines.
Yeah.
And Whole Foods, as it was having problems, so...
They were?
They were.
What type of problems?
So, Whole Foods caters to the organic market.
To the rich folk, yeah.
No. To the young, vegan, all of that. The new lifestyle that's coming up, more people are going towards organic, and I'm doing quotation marks, organic, foods, and really all the grocery stores started their own organic brands like Costco, Loblaws, what are the States, Price Chopper, all of these brands started their own organic things, so people stopped going to Whole Foods, and Whole Foods is super expensive as it is.
Yeah.
You can get like an apple for like $4 at Whole Foods. So super expensive. They were struggling as it is, but I think one thing they have in common, Amazon and Whole Foods both cater to millennial market. Big time.
Okay.
So those are some big drivers, and it'd be curious to see what synergies Amazon can extract from that acquisition.
Yeah. And if they want to do that futuristic store, maybe since the margins are so good, it was a good target, but then again, if they're struggling, who knows? But mergers don't always work out the way the companies want them to work, but when they do, stock price does go up.
Oh yeah, big time.
Yeah.
Big time.
So now we can talk about, it's not really analyst reports, it's more analyst opinions, right, about the stock. So Ali's going to walk you through it, since, he didn't do any talking in the last episode. I think it's only fair that in this one...
I do all the talking?
You do it, not all, but, a good amount.
Well, I guess the brains has to do the talking, right?
Yeah, exactly. Exactly, the better half of the show, especially given my sleep predicament. Anywho, not being able to fall asleep in the morning. Oh my god. Anyway, I feel like I'm 72. Okay, let's go.
You are Julian, secretly. Anyway, so analyst recommendations... it can be a good tool just to give a general indication, but remember, these are usually banks and investment firms that are publishing analyst reports, so take it with a grain of salt. They may not always have the investor's interest in mind because they are in the business of making money.
Yeah. And what an analyst report is, just to, go at the beginning. Well, the segment that we're going to talk about is... It's going to be the opinion of the analyst. So an analyst looks at a stock and he rates the stock based on the value that he thinks the stock has according to a formula. So let's say the stock trades at $20 and then he runs his formulas and then he says, the stock should be at 23 according to my discounted cash flow analysis or whatever other analysis they choose to use. Therefore, I'm going to have a positive target or, a higher price target. And then I'm going to give a positive rating onto the stock, right? Mm-hmm. So that's sort of the type of report that we're going to be talking about. But there are many types of reports. There are annual reports, which is what the company issues. Analyst reports, which are, reports every quarter, every year, depending on how closely the analysts or the investment bank or the investment firm or whatever track the stock. And then there's an initiation of coverage, which means they never covered the stock before, but now they're going to cover it. So they're going to talk about the industry, talk about the company, talk about the competitors, and blah, blah, blah. But now we're only going to be talking about a small segment, which is really what attracts the investor's attention most of the time. Doesn't mean it's necessarily the best thing, but it definitely does attract your attention most of the time.
And usually on Google Finance, on that tab on the right, all of those little hits that you see, rating reaffirmed, PT16 or Piper Jaffray starts the coverage. That's what we're talking about. Yeah. Those are the kind of reports that analysts are doing. So let's dive right into it. There's a few key variables I want to go through. So we'll start with the first one, which is, let's start with outperform.
Okay.
So outperform falls...
Well, we should actually start in some sort of order.
So I'm trying to think of that order.
Okay, yeah, you think of the order.
I'm trying to think of that order.
A moment of silence for Ali, please.
I'm trying to Okay, we can start with the price target.
Okay, go for it.
Let's start with the price target.
Yeah.
Easiest thing. So the price target is the analyst's opinion, like Julian said, based on the analysis that they do, where they think the stock is going to be. So, for example, Apple, let's say it's trading at $100, and an analyst is going to say, okay, based on this metric, based on this acquisition, based on these future growth drivers, and he'll calculate the book value of the share, and he'll say, okay, wait, so now we're setting...
It's called DCF.
Yes, discounted cash flow valuation. This is what we're setting the value of the stock. Sometimes the value that they set may be below or above even the current market price. So in that case, it could be that the analyst is saying, hey, maybe the stock is overvalued, maybe the stock is undervalued, but they're just issuing the price target. Yeah. On those lines, with the price target, usually the analyst is going to either assess it as outperform, underperform, or equal. Like it's gonna move at the same pace. So outperform means that it's gonna outperform the general index, and by index, the technology index. So Apple, it's gonna outperform the technology index.
Yeah.
Underperform, it's gonna underperform the technology index. And equal weight, meaning it's gonna grow probably at the same rate as most of its competitors.
Okay.
Those are those three. Along those lines as well, we have the overweight, we have underweight, and we have equal weight.
Okay.
So the overweight can apply in two ways. It can either mean that the analyst is either saying that, hey, this stock is probably going to go up, so I would purchase more of the shares. Underweight is the opposite. They think it's going to go down, so you should sell some of the shares. And equal weight means it's neutral. It doesn't just hold your shares.
Okay.
But the overweight can also fall into a different field, meaning that in terms of your asset allocation, which we talked about before, some people may decide, hey, they want the index, let's say the index is proportional wise, 10% of the index is allocated towards technology. So the overall index, let's say the index of the Dow Jones is 10% in technology, for example, and an analyst says we need to overweight in technology. That may seem that you may need to purchase more stocks in technology. So you tip the scales in terms of your asset allocation, meaning more of your portfolio is towards technology.
Yeah.
And that's what the overweight means in that sense. The underweight is the same example, but just in reverse. If he says, technology, it's struggling right now. Some of the drivers aren't there. The market is really saturated. New product development has slowed. They might say, instead of having 10% of your portfolio in technology, maybe bring that down to 8 and reduce the holdings in that area.
Yeah, and from those different ratings, that's when you see the classic buy, hold, or sell.
Mm-hmm.
They take all these data points, and then they sort of give out their opinion on the stock, buy, sell, or hold, which is what you see normally on Yahoo Finance. I know that they have like the amount of analysts that say buy, so maybe you have 19, and then 2 say hold, and 3 say sell. So then you get the general consensus of what the market thinks. I know it's analysts, but analysts, the market, usually they go hand in hand. It's very rare that you're going to have a contrarian analyst that's going to say something completely against what the market's doing. And yeah, so anything else you wanted to add when it came to the terms and stuff?
Terms, I think that's mostly it.
Yeah,
for the terms. That really gives you the basis on how to sift through those. Some firms also, I know like Zacks Investment Research, they have a 0 to 5 scale in which they rank investments on.
Okay.
The closer it is to 5, the closer it is that they would issue a buy rating. The closer it is to 0, the closer they would issue a sell rating.
Okay.
So they use different metrics in there. I'm not too familiar on what metrics exactly they use. Probably
but
DCF.
every firm will have... Yeah.
Every firm has different criteria, but they use a 0 to 5 they use a 0 to 5, and that's how they issue their recommendations.
Yeah.
But there is a downside to analyst recommendations.
Okay, but before we get to that, I just wanted to add something that, kind of goes hand in hand with this. Not really, but it's the... I lost the word. revenue forecasts and the earning per share beat and revenue beat.
Okay.
I lost the word. What's
earnings
the word?
Reports? Analysts?
The targets.
Consensus?
The consensus for the earnings, right?
Okay, yeah.
So
the earning targets.
if they beat earnings, then the stock goes up. If they if
they beat earnings, or if they don't beat earnings, essentially, if they miss earnings.
Yeah, and it's earnings and revenue, right? Earnings per share.
Earnings per share, and revenue forecast.
And then there's the industry growth. Sort of, the growth.
For retail, they do same store sales growth.
Yeah.
And then for different industries, there's different markets. For Apple, for sure, they look at how much they've taken from the competitor. If Samsung sells more phones, and all of that gets forecast. But different industries are going to have different value.
Yeah. So if an analyst says, buy the stock, and he gives a earnings target, or odds are he's going to give a more positive, or a higher target, and he's probably going to estimate that it's going to beat the target. So that kind of may skew the whole market opinion. Oh, this stock's probably going to beat the earnings estimate because they've been doing so great. And then if the analysts don't bump it up higher and they leave it, at the same as if the stock were doing okay, then you're probably going to see an earnings beat according to the analysts. But since people think the stock's going to be doing very well, if the stock just beats it by a little bit, then the price movement may even go down because it wasn't as much of a beat as what they expected it to be. Mm-hmm. And the same thing if you look at the downside. So that kind of works with the market consensus and the analyst consensus, and then the earnings period, and how a positive rating may not help a stock in earnings because people are going to be expecting the stock to do much better than what was estimated by an analyst. Mm-hmm. So anyway, the downside to this, you can take it away, Ali.
There's a couple of downsides. So first, I'll start with a quick thing. When companies IPO, there is no analyst coverage allowed at the beginning.
Okay. Yep.
And usually I think that's a 30 to 60 day period where analysts are not allowed to issue any recommendations. They can't issue any ratings, and usually they're never allowed to initiate coverage, and that is exactly for they want to avoid any volatility and any unneeded movement in the stocks. And it's the same thing. Institutions that underwrite the stock, or big institutions that own chunks of shares, are not allowed to sell, and insiders of the company as well. They're not allowed to sell until 90-day period has passed, and that's to avoid fluctuations in the stock. So the downside with analyst recommendations, each analyst usually is tied to a firm, and that firm may or may not own shares in that corporation. So if you have something like Wells Fargo or Piper Jaffray that issue, let's say, an outperform for Apple, if the stock today is at 100, they issue outperform for 120.
Yeah.
And now I look at the report, I'm like, oh wow, Piper Jaffray issued 120 price target, it's 100, and they issue outperform.
Yeah.
That's a 20% upside. I should buy it.
Yeah.
And then I read it, I tell Julian, he's like, yeah, that makes sense. He buys it. Then we tell our friends, and so on and so forth, and word of mouth. And now so many people have bought it.
Since we have such rich friends,
Exactly. I buy one share, you buy one share, the whole world buys one share, I think.
Yeah.
Okay.
Yeah.
I thought the power just went off. But anyway. No. So yeah, what happens now is you have huge upward swings in the stock due to volume, and Wells Fargo and Piper Jaffray are really happy because they own millions of shares, and a small little increment makes them a lot of money.
Yeah.
And then they can end up even selling the shares.
Can they still do that today? I don't think they can do that.
They can and they can't, but nothing is stopping them from issuing these analyst reports.
Yeah.
Because there's millions and millions of analysts.
Yeah.
So
well, not in a firm, but
no, but around in the US, there's a lot of firms.
Yeah.
There's 25 firms that constantly issue analyst recommendations. Some are bullish, some are bearish. So bullish going up, bearish going down. But you really have to take these reports with a grain of salt. And that's why you're going to see, if you look at different analyst reports on the same stock, there's not going to be a same report that's going to have the same price targets, that's going to have the same ratings.
Yeah, because they use different assumptions, and that leads to different price targets. And it's also very rare that you're going to see an analyst report that's bashing a stock.
No.
It's much more like,
positive.
80% of the time, let's say, I'm not sure exactly, but let's say 80% of the time it's going to be positive outlooks on the different stocks. Just because that's the way the world works. And another thing that you need to take into account when you look at these reports...
Everyone's an optimist.
Yeah, exactly. They're not going to make money if the stocks crash, right? So they want it to become a self-fulfilling prophecy, and markets are great, economy's healthy, price target is up, 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 and the markets just keep going up.
But it could also be the case when you have a really bad situation, like something that happened with Home Capital, that you have people, no, I wouldn't dare go into the stock.
Yeah.
And then you see the stock bottom out, and then you see, oh yeah, we took a 10% position in the company. Yeah, we think it can bounce up. And then I think CIBC at one point had an 18% position just out of nowhere.
Yeah.
And then they sold it when it doubled.
Yeah.
So it's really interesting. Usually when the ship is going down, that's when you're going to see analyst recommendations think, oh, sell, 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 sell.
But that's exactly when you should be buying.
Yes and no.
Kind of.
Yes and no. If it's a sunken ship, don't go near it.
Yeah, but you don't.
But
yeah.
it honestly depends. Like with Home Capital, how could you? Yes and no. I took the risk. I went in. I don't recommend that you do or not.
Yeah.
I don't want to put out a buy or sell on that. That's not what this podcast is for. But a situation like that, some investors may look at it, even though the analysts are saying maybe it's time to buy now. You don't know.
Yeah.
You don't know where it's going to go. And that's the thing with stocks. You never know. There can be millions of analyst reports saying, yes, the stock is going to go up. And then it could tank. Yeah.
And something else that you need to keep in mind is the whole finance world is a very short-term world. So if they say overbought or oversold or buy, sell, hold, they're talking about really short-term because that's just the way the world works.
Thank you for mentioning those two terms.
So if you're looking at a value play, like a stock that had a PE crash, right? So the value went down. The fundamentals are still there, meaning the company is still, healthy. They've had a couple of hiccups here and there, but the company's still fine. But then the stock price tanked, let's say 20%. The analysts are going to be saying very negative things about the stock because it tanked 20%, because in the next quarter or two or three, there's not going to be a trend reversal. The economy isn't going to help them, but maybe 2 years down the road, the stock's going to start experiencing growth. Now, this can be a great example. An example of this would be a merger, right? So, like, acquisition. So, Whole Foods and Amazon. Amazon bought Whole Foods. It might take them 2-3 years before they can really extract all the cost synergies or the revenue synergies or any other synergies that existed in the acquisition, and that's when the stock price will really take off. Mm-hmm. But it's for the patient investors that invest at the beginning when the stock is at its lowest due to that merger or acquisition, that'll really benefit it. But the analysts will start telling you to buy once it's too late.
Of course.
And that's really the problem when you look at any value play. It's really rare that analysts, not necessarily people that write articles for fun, but analysts that work in banks, it's really rare that they're going to give you a buy signal on a value play after a stock tanked.
It was a good quote by Warren Buffett. He said, once you read about it in the Wall Street Journal, it's way too late.
It's too late.
It's way too late. But I do appreciate Julian bringing up those 2 points. Oversold and overbought.
Thank you, Ali. Thank you.
Those are actually 2 points on analysts that actually pop up a lot. And for value investors, that's actually not a key metric, but something that they really look at. So oversold is when the company, it's exactly as it sounds. They've sold people, they believe the analysts have sold the stock too much. And the reason why it goes down, we talked about the volume going down. That's exactly the reason. It's so many people are selling. So many people, it can either be panic. It could be, most of the time it's panic. It could also be the case that...
Panic, bad news, earnings miss, something,
It's mostly panic.
Yeah,
but
it's news. It's bad news.
It's bad news. It's speculation. It's very rare that it's because the company's fundamentals are entirely in the crapper and the company's going down and this and that.
Yeah.
And overbought is when it's the opposite of that. It's when the speculation is so good, when so many people are interested in Tesla. Yeah, when so many people want it to go up and they just keep plowing money and the PE keeps rising, and it's usually not because the fundamentals are strong, the revenue growth is going up, the profit is going up. It's just pure speculation.
And the future outlook. People are betting on the future. So if you're talking about a company like Tesla,
that future is already priced into the stock.
But that's why it's so expensive.
But then more people buy it, it just makes it more expensive.
Of course. It makes a lot of people rich.
And that's why you see when those like Tesla, when they miss earnings, they tank hard.
Not so much but if they lower their guidance on the industry, saying that they're gonna ship less cars, that's gonna hurt.
Yeah.
Or that EV is in the way to go, and it's.
I think when they had the SpaceX, the engine or something, it fell or something, it blew off on one of their launches. That stock went down.
What's Tesla?
Yeah, they own SpaceX.
But come on,
the stock went down 6-7%.
Yeah,
just like
SpaceX
that.
Is
and it's like.
It's kind of like a fairy tale for now. I don't see why people are pressing that into the stock.
Apparently, it's $250,000 for a ticket to Mars on SpaceX.
Yeah, well,
you can already book seats, by the way.
I'm sure, yeah.
And Virgin Galactic, too.
Just like you could pre-order the Model 3, and it's still not even in production. Although, no, it should be starting soon.
You get a nice sketch of it by Elon Musk in the mail.
Exactly. You don't need to know the specifications, but $1,000 deposit. Is it refundable?
Yeah, I think so.
I don't know, but it was a lot. They received a lot of money. I think 400,000
in Montreal. People lined up for it. They lined up with their checks ready to sign it up.
I'm sure.
Yeah.
Is it 1,000 Canadian and 1,000 US, or is it 1,000 US in Canadian?
I don't know. One day we'll know.
Yeah. Well,
we go buy our Teslas.
Sure.
If the company's still around.
Yeah. So what else could we say about analyst reports besides the fact that they're usually wrong?
They're usually wrong. No, they're not. Wrong. They're not usually wrong. They're misleading. They're misleading. They're a good thing to see just to take a quick glance at them. But
it's the best way to understand what the market consensus is.
Exactly.
Not necessarily what to do.
Don't base your thesis on it.
Yeah. No, you should have if you're picking stocks like Ali here, you should have an investment thesis before you just look at a buy, sell, or hold and decide on how you're going to act.
I think that's it.
Anything else that we want to say?
I think we hit
this is your expertise.
I think we hit all of them.
Yeah. Okay. Great. Well, thanks guys for tuning in. Sorry for the delay. Ali's been really busy going out to family dinners or something.
Dinners, work, internship.
Yeah. Even okay. Sure.
Everything.
Sure. Yeah.
Everything.
You're doing something on the side.
Blogging. A little bit of blogging. I actually wrote about Amazon and Whole Foods. You should check it out on what'sinstocktoday.com.
Yeah,
that's
for it.
There. Anyway, we wish you a good night or good morning or good afternoon wherever you're listening.
Probably afternoon.
And we'll see you in the next one, guys.
Yeah,
thanks for listening.
Guys.